Welcome to your daily market briefing. Here are the key headlines shaping today's markets. 1. Trump signals Navy escort. Iran diplomatic outreach emerges. 2. China, NPC, sets 4.5 to 5% growth target. Rebalancing takes priority. 3. Korea, Kospi rebounds 12% after historic crash. Sentiment whipsaws. After the headlines, you'll find a global market snapshot and a forward calendar of what to watch. Before we turn to today's stories, a short introduction. Daily market briefing. Think ahead, every market day. Subscribe to stay focused on what matters. Please keep in mind that all content in this video is for educational purposes only. It provides market context, not financial advice. 1. Trump signals Navy escort, Iran diplomatic outreach emerges. 1. Strait of Hormuz crisis escalates as Iran claims tanker strike. Primary asset classes impacted: crude oil, Brent, WTI. Energy equities globally: UST curve, 2 years, 10 years. DXY, gold, European and Asian equity indices, stocks 50, Nikkei, FTSE 100. What happened? WTI surged 8.5% to $81.01, and Brent rose 4.9% to $85.41 after Iran's Revolutionary Guards claimed a missile strike on a U.S. tanker in the Persian Gulf. At least 200 vessels remain stranded near Gulf ports for a fifth consecutive day. Qatar Energy declared force majeure on LNG shipments. Goldman Sachs raised its Q2 Brent forecast by $10 to $76. Why it matters. The Strait of Hormuz handles roughly 20% of global oil and LNG supply. A prolonged blockade compresses available inventories, raises input costs across the industrial chain, and feeds directly into headline inflation prints. Higher energy costs tighten financial conditions and erode real consumer spending, creating a stagflationary transmission channel. Central banks face renewed tension between growth support and price stability, complicating the rate path. European economies with high energy import dependence are disproportionately exposed. Key numbers to remember. WTI plus 21% week to date. Largest single-day gain since May 2020. Approximately 200 vessels stranded near Gulf ports. 20% of global oil/LNG supply transits Hormuz. Goldman raised Q2 Brent forecast by $10 to $76 per barrel. What to watch next? Any credible ceasefire signal or diplomatic backchannel between Washington and Tehran would trigger a sharp reversal in crude and energy equities. Monitor whether Saudi Aramco's Ras Tanura facility, reportedly struck, resumes full export capacity. OPEC Plus emergency production response remains the key supply-side variable. If disruptions persist beyond 1 week, expect upward revisions to March CPI nowcasts, reinforcing a hawkish repricing in front-end rates and pressuring rate cut expectations. 2. German Bund yields spike as fiscal expansion reprices European rates. Primary asset classes impacted: Bunds, 2-year, 10-year, Euro to US dollar, European equities, DAX, Stocks 50, banks, defense. Periphery spreads, BTPs, OATs. What happened? Germany's 2-year Schatz yield surged 13 basis points to 2.26%, and the 10-year Bund rose 11 basis points to 2.85%, the steepest daily move in months. The sell-off reflects ongoing repricing of the €500 billion infrastructure fund and defense spending exemption from the debt brake. The DAX fell 1.6% as higher discount rates offset fiscal optimism. Broader European equities: Stocks 50 minus 1.5%, FTSE minus 1.5%, also declined. Why it matters. Germany's constitutional fiscal overhaul represents a structural shift in the European sovereign yield landscape. The 2-year Schatz at 2.26% narrows the policy gap with the ECB deposit rate, effectively tightening monetary conditions independent of ECB action. Rising Bund yields pull periphery spreads wider. BTP Bund and OAT Bund spreads are expanding, increasing funding costs for more leveraged sovereigns. This repricing challenges the ECB's ability to ease further as market rates move against the central bank's intended path. Key numbers to remember. Germany 2-year shots, 2.26%, plus 13 basis points single session. Germany 10-year Bund, 2.85%, plus 11 basis points, highest in 3 weeks. 500 billion euro infrastructure fund plus defense spending exempt from the debt brake. What to watch next? The ECB monetary policy meeting on March 19th is the next catalyst. With bond yields repricing sharply higher, the Governing Council faces a dilemma. Markets have effectively tightened conditions. Watch whether ECB rhetoric acknowledges the fiscal shift or pushes back on rate cut expectations. German Bundestag budget implementation votes and defense procurement timelines will determine whether the yield move is sustained. A dovish ECB tilt could weaken EUR and compress periphery spreads. 3. China lowers GDP target to 4.5 to 5% as NPC signals measured stimulus. Primary asset classes impacted. Hang Seng, MSCIEM, USD/CNH, copper, iron ore, A-shares, Shanghai Composite. What happened? China's National People's Congress set the GDP growth target at 4.5 to 5% for the first time as a range, down from last year's around 5%. The budget deficit target was maintained at a record high to support spending. Stimulus measures remain calibrated rather than aggressive, with emphasis on domestic consumption and tech self-sufficiency. The Hang Seng closed modestly higher at 25,321, plus 0.3%. Why it matters. A lowered GDP target signals Beijing's acceptance of a structural growth slowdown, reducing expectations for outsized stimulus that would lift commodity demand. The range format provides policy flexibility but caps the upside for industrial metals and bulk commodities reliant on Chinese construction. For EM assets, the measured approach limits near-term re-rating potential. The signal is mixed. Record deficit spending supports domestic equities, but absence of a property rescue package constrains broader reflation expectations. Key numbers to remember. GDP target cut to 4.5 to 5% range, from around 5% previously. Budget deficit maintained at record high levels. Hang Seng plus 0.3%. MSCIEM plus 2.1%. Broader EM bounce on risk recovery. What to watch next? Granular policy implementation through PBOC actions and local government special bond issuance will determine whether the fiscal target translates into real economic stimulus. Watch copper and iron ore prices as proxies for Chinese demand expectations. If the NPC session concludes without a significant property sector package, expect further pressure on CNH and China-sensitive commodity exporters. A surprise PBOC rate cut would reignite EM carry trades and support AUD/USD. This global market snapshot is designed for quick reference. You may pause the video to examine the data more closely. This forward calendar section is designed for quick reference. You may pause the video to examine the data more closely. Thank you for watching today's briefing. In markets, understanding the field matters as much as making the move. And that's the perspective we aim to provide. Subscribe to Daily Market Briefing and turn on notifications to stay focused on what matters every market day.